Hello everyone. In this video, we'll discuss about the concept of moat and we'll also talk about the various sources of an economic moat, and then subsequently we'll see that whether how to identify if a company has a moat or not. So before we get into the video, I'll just inform that this video is basically in continuation to my previous video which I made on the process of investing, wherein I summarize this entire process of investing, which basically begins with what to buy, which is followed by when to buy, which is again followed by how much to buy, and followed by when to sell. So basically, this particular video is a part of what to buy, which Warren Buffett has clearly mentioned that one an investor should only buy those businesses which have moat around it, or which are protected by the structural competitive advantages, or which act as a barrier sort of thing, wherein the companies which are a part of that industry continue to enjoy good returns on capital. So we'll talk about all these things in this particular video. So as you can see from the diagram that a moat is basically a water filled trench which has a lot of sharks and crocodiles in it, and basically this concept was used way back in medieval times, where these moats were used to fend off the invaders, or not to allow the invaders to invade the entire capital, or let's say a fort or a town or a castle or sort of something. So in equivalent to its application in business, what Warren Buffett has said, that investors should only invest in companies which have some sort of structural advantages around them, which can fend off the competition for many years to come. And then over this and throughout this process, the company continues to enjoy high returns on capital invested, or as we call it, returns on capital employed in Indian business, from an Indian business perspective. So basically, why Warren Buffett stresses so much on moat is because we all know that capitalism is brutal. Whenever any industry has, wherever, let's say if a industry X is being operated by only one or two players, and over some, for say, let's say 4 to 5 years, these A and B players which are catering to this industry X have enjoyed a good returns on their respective capital. So usually what happens is that, since capitalism is always it attracts the competition, and also this excess returns what these two players which are currently in this particular industry, it will be, this particular excess returns will start attracting the competitors, and then over a period of time, when there were only two players, we can see that now lot many players have come, and over the process what happens is, since there are only, so earlier, let's say there were two players, and now that the same industry is being catered by 10 players, obviously the profits and all would be shared within these 10 or 12 players that have now come out, and as a result of which, the original players were there, they have seen their control, or they have seen their returns on capital getting diluted. So it is imperative for a good business to ensure that no one can reach within their territory, or no one can come in their territory and snatch the market share, or in the process doesn't dilute the return on capital employed. So that is why Warren Buffett always stresses on only investing in companies which have some sort of moat around them. So some sort of structural barriers, some sort of inherent advantages these companies have, which for which the competitors, will it will be very difficult for the competitors, or the other players, to enter into the market and snatch away the excess shares. So basically, so there are two ways to identify a moat. I'll be talking them first from a qualitative perspective, and then I'll also talk from a quantitative perspective as well. So when I say qualitative, it means that there are usually five sources of modes which I have written down, and they are not in some particular order. So basically, broadly, there are five sources of to identify whether a company has an economic moat or not. So the first one is intangible assets. Second is switching cost. Third is network effects. Fourth is cost advantages, and fifth is efficient scale. So these are by so all these five sources of modes are by itself are very are in are very deep in concept. So I would urge all the investors out there to read a book called Little Book That Creates Wealth by Pat Dorsey, or you can also read a book by a book called Why Moats Matter. And basically both these books have been written by analyst of a company called Morningstar, which operates in US, which gives a lot of this which basically they are equity research analysts, team of equity research analysts, which analyze these companies. So basically, they have done a beautiful job of this, putting up a mode framework and all. So I have also lifted a majority of the content from that book only. So I would advise all the investors out there to read these two books. I'll repeat it again: a little book that creates wealth by Pat Dorsey, and Why Moats Matter by Morningstar analyst. So what they have done is more or less the books are more or less talks about the same. The books talk about the same thing, that there are five sources of economic moats. So the first one is intangible assets. So when I say intangible assets, it's basically the companies which get benefited by their intangible assets. So basically, companies which have intangible assets like brands, patents, and regulatory licenses. So these attributes allow the companies to produce their respective goods or services that cannot be replicated by the customers easily. And as a process of which, all these companies which produce such sort of things, which are benefited by their either brands or patents or regulatory licenses, they enjoy a good return on capital over a period of time. So basically, a simple example would be like, iPhone or Apple, I would say, because Apple charges premium because of the brand part, right? So you can say that, if Apple can be considered as a beneficiary of brands. Similarly, you can also have a lot of these companies which operate in pharmaceuticals, because they have these patents and all, which doesn't allow. So whenever a company has a patent, it protects that particular company and doesn't allow other companies to produce the same product, or or replicate the strategy that has been developed by the company which got it patented. So all these qualitative factors, like, or sometimes if especially about the utilities part, where the government gives them the regulatory licenses. So only the utilities, I mean, giving the licenses in itself is a very big task. So companies which are in utility sector, they get benefited cause of it, because of the regulatory licenses, because the government doesn't give licenses so easily and doesn't happen very frequent, right? So all these companies which have these sort of advantages, or which get benefited from such sort of attributes, can be categorized under companies which have an intangible asset in as their respective modes. Second is switching cost, wherein the companies which so wherein the products or services that a company sell is hard for customers to give up, thereby creating high switching costs. So basically, let's say if a person has opened an account in an X bank, let's say in a X bank. So these accounts are basically also known as sticky assets, right? So you don't have a bank accounts in more than two or three banks, because we know that it's sort of, now that it has become easier, but then in early days it used to be a very sort of complex, I would not say complex, but then very I mean messy process. So now that with the digitization and all these things, now the process has been smoothened very enough. But then again, let's say if a company has if a company has a SAP as their enterprise software. So if a particular company uses SAP's enterprise ERP system, but then if they want to switch it to, let's say, Oracle, or maybe some another ERP system, so they may have to calculate a lot of repercussions, that what is the cost of, because they may have to stall the business for a few days, right? Because it cannot happen parallelly, right? So it has to be stopped for some time. So wherever the cost of switching doesn't justify the benefits that may come out of it, so such sort of companies can benefit from the switching cost as well, right? So that is how we would define a switching cost. Third one is network effects, wherein the value of a particular product or a service increases for both existing as well as new users, thereby creating a vicious circle. So basically, what it tells is that strong companies become even more stronger. So an example of this would be a company called Dassault. I hope I'm pronouncing it right. So it's basically a French company which produces 3D softwares, 3D computer aided softwares like CATIA, and PLM, that is product lifecycle management softwares like CATIA, and the 3D computer aided software, computer aided design softwares like SolidWorks and all. So basically, what happens is, so lot of these automotive companies use these sort of softwares which are which are produced by this company called Dassault, which is basically a French conglomerate. A lot of these employers or a lot of these automotive companies use this software, and a particular so people who are usually from mechanical engineering background, they might have this exposure of software called CATIA and SolidWorks. So basically what happens is, since the students are also because students know that their future employers might be only selecting, might be only interested in those candidates who have knowledge about these two softwares. So the value of these softwares increases exponentially, and since the employers on the other side know that they are only interested, because a lot of students study only this particular software, so the value for that software also increases. So it's basically a win-win for both students as well as their future employers. And because of which, what happens is, since more and more number of students and more and more number of employers use this particular softwares, the value of a product or a value of a goods or service increases tremendously. So a lot of there so basically a lot of companies are there which have this network effects going on for them. The fourth attribute, or the fourth economic source of economic mode, is basically a cost advantage, wherein the companies that have an advantage of producing product or a service at low cost can attract more business and can have fat operating margins. So usually companies which have low cost, so basically the companies which are low cost producer or low cost operator are the companies which tend to enjoy cost advantages, because they can withstand the down cycle better, and during the up cycle they can even match the prices of their competitors, and in process get have enjoy good profit, operating profit margins. And the last source would be is efficient scale, wherein if there is a specialized market, or if there is a niche market which has a limited size, and then if it is being currently served by one or two players, so whether it's a monopoly or a duopoly, and if the particular market size is also very limited, it doesn't increase like the other markets. And if that market is being currently served by only one or two players, then those two players, one or two players, would have good return on invested capital, or good return on capital employed. And one of the key factors here is that since the market size is limited, so it doesn't become point for a new entrant to enter into this, because that would result in the dilution of the profit margins of all the companies out there. So companies wherein the market itself is of limited size, those sort of companies which operate in that sector are usually the beneficiaries of efficient scale. So these are broadly the five sources of economic modes. So as I said that one can definitely look through the companies from this particular angle and see if the company is enjoying any one of these sources of economic mode. Now, the next point is, how do you identify it quantitatively? Now, in the previous slide, we discussed that how can we can identify it qualitatively. In this slide, we are going to discuss how we can, identify a mode quantitatively. So, as I've been talking a lot about in my previous slides as well, that one way of identifying that, quickly checking its return on capital employed is greater than weighted average cost of capital. And I have made a lot of videos on how to calculate weighted average cost of capital, so you can definitely check out my previous videos as well. So if a company has a ROS, which is return on capital employed, greater than WACC for long period of time, and again the focus is on long period, not for shorter periods of time. We are focusing on 10 years, 15 years, 20 years down the line. So if a company is consistently increasing, or if a company is consistently posting the rows which is in excess to its cost of capital, or to a specific weighted average cost of capital, then we can expect that such sort of companies are the beneficiaries of at least one of the sources that we have just talked about in the previous slide. And basically this excess return of ROS over WACC, which is also called as economic profits in business language, and it is this excess or the spread which creates value for the shareholders over the long period of time. And as I mentioned, we are not looking for companies that post good numbers or good growth only for a brief period. So, for example, a typical example would be a cyclical industry, wherein a typical upcycle stands for 3 to 4 years, followed by a down cycle of again at least 3 to 4 years. So, it's a typical cyclical nature in which these companies, so basically companies which operate in automotive sector, cement, steel, and all these commodities and all. So basically, all these are cyclical sectors, and so we're not looking for those companies which post good numbers only during good times when the economy is doing good, but then we are looking, as I mentioned, for 10, 15, 20 years long, over a long period of time, wherein the company, if a company is able to post good rows over WACC, then that is what we are looking at. And also we are also looking, we are not too much hell bent on the magnitude of the spread, but then we are looking for modest spread, but then that should last for 15, 20 years down the line. So that is how these two graphs show that if a company has, so the left one is that company with a moat. So sorry, the left one is the company without a moat. So if a company doesn't have a moat, you can easily see that it's over a short period of time, its rows will gradually come down, or to it will erode over a period. It will erode over a period of time. But then if a company doesn't have any moat, then that time duration will be very less. Whereas in the right hand side chart or the right hand side diagram, the company which has a moat, although because we know that nothing lasts forever, right? So eventually all the excess return would get vanished, but then it will not happen very fast. It will take its own sweet time, and by that time the shareholders would have been profited immensely. So as you can see that the orange color is basically the area of the triangle, and this basically denotes the value which has been created for shareholders over a period of time. So if a company which doesn't have more doesn't create much value, whereas if a company which has a moat creates enormous value for its shareholder. So that is what this particular graph denotes. So that was about it in this video, and I know this concept is very much, it is in very much detail. So as I mentioned, I request all investors out there to read out those two books that I mentioned. That is, I'll repeat it again: The Little Book That Builds Wealth and Why Moats Matter. So both these books have been written, and you can read either of them because more or less they are all on the same lines. But then the idea is very simple but very strong, that one should only invest in companies which get benefited by the structural advantages, and few companies by its nature, by the nature of the industry in which they operate, few companies are beneficiaries, whereas as I mentioned, companies which operate in typically in a cyclical sector, they don't have much in their way, or companies which are more in capital intensive industry, they don't have much in their way. So you can definitely read out those books, and if you guys have any queries regarding this video, or if you want to know anything more about the mods and all, you can let me know in the comment section, and I'll be happy to help you out. So that's all for today, folks. Thank you and have a nice day.